Here's what doesn't make sense. This week, Chainlink locked infrastructure deals with institutions managing over $2 trillion in assets. Deutsche Bank's entire wealth management stack, $240 billion in government property data, BlackRock's CEO publicly pushing tokenization on CNBC, and Link's price is sitting at $16 to $17, approaching multi-year channel support. Either the market's pricing in failure nobody's talking about, or we're watching smart money accumulate while retail capitulates. The RWA tokenization market just crossed $35 billion, Standard Chartered's projecting $2 trillion by 2028, and Chainlink securing 67% of the entire Oracle market by value. So why is price at the same level as 2023? I'm going to show you exactly what this disconnect means, whether the technical structure supports a reversal or a breakdown, and why my load zone starts here despite the bleeding. Because something has to give, either these partnerships are worthless, or this is the setup nobody's recognizing yet. Link's been grinding down since September's $23 rejection. 9 consecutive red Heikin-Ashi candles on the weekly chart. After a new dip to $16, we're now around 17, testing the 100-week EMA that's acted as support multiple times since 2023. Standard correction pattern, nothing unusual there. Except this isn't happening in a vacuum. While price bleeds, institutional adoption's accelerating faster than any previous cycle. Not vague explorations or pilot programs, actual production deployments with dollar figures attached. This creates a question every trader needs to answer. Is the market forward-looking and pricing in some failure mode we don't see yet? Or is this the definition of a mispriced asset, where fundamentals are running one direction and price is lagging 6 months behind? October's developer activity rankings put Chainlink at number 1 with 385 downloads. Oracle market share sits at 67%, securing $93 billion in value across 480 protocols. The infrastructure layer is expanding while price contracts. That divergence is why this video matters now. We're either at a major accumulation zone before the market catches up, or we're about to see why the smart money was selling into these announcements. Let's break down what actually happened this week versus what the price action suggests. Deutsche Bank, not a DeFi protocol, an actual €1.6 trillion banking institution, integrated Chainlink's CCIP for their EuroAU stablecoin launch. Their wealth management division alone handles €645 billion. When you process transactions for that scale, Oracle reliability isn't optional. They picked Chainlink's tech stack over every competitor because failure at that scale means regulatory catastrophe. Link now processes fee revenue from $2 trillion in institutional capital flow. The market is treating this like it doesn't matter. Second, Balcony's partnership puts $240 billion in government property data on-chain using Chainlink's runtime environment. Real estate tokenization moved from theory to production. Local governments are the data source. This isn't synthetic or startup sourced. When you tokenize the world's largest asset class at scale, every transaction needs verified data feeds. Chainlink is the infrastructure layer for that entire vertical. But price doesn't reflect it. Third, the macro narrative just shifted into second gear. RWA tokenization hit $35 billion this month, up 8% in 30 days during a market correction. Private credit leads at $18 billion. U.S. Treasury tokenization is at $8 billion, with BlackRock's Biddle Fund capturing $2.8 billion of that market alone. Standard Chartered CEO just went on record projecting $2 trillion by 2028. BlackRock's Larry Fink disclosed they're building proprietary tokenization technology. When the world's largest asset manager says traditional finance is moving on-chain, that's not speculation, that's the migration starting. Here's the piece that matters. Every tokenized asset needs price feeds, cross-chain interoperability, and proof of reserves. Chainlink's market share in Oracle's is 67%, nearly 7x larger than the next competitor. The RWA market growing from $35 billion to $2 trillion means 57x more infrastructure demand. Chainlink already won the infrastructure layer. As traditional finance migrates on-chain, fee revenue scales with every additional billion tokenized. So either this adoption is a mirage, or the market's not pricing in what's directly ahead. The technical structure will tell us which scenario we're in. On the weekly time frame, we're working inside an ascending channel that's defined Link's structure since August 2023. The lower support line connects lows from 2023, 2024, and 2025. The upper resistance connects March and December 2024 peaks. The channel's been respected through multiple small cycles, which gives it statistical weight. But here's the thing. Starting in August 2025, a downward trend line formed at that $23 high. We've seen two clean rejections in September and October at this line. That creates a compression pattern, ascending support below, descending resistance above. Price is squeezed between $15 and $19. These patterns typically resolve with momentum in one direction. For moving averages, the 200-week SMA and 100-week EMA, the structural support lines in yellow and green, are both below current price. Long-term trend stays bullish. But we're underneath the 10, 21, and 55 EMAs, the purple and blue lines showing short-term bearish momentum. When weekly price sits between the 100 EMA and 55 EMA, we're in neutral territory where either direction can take control. Fibonacci levels matter for targeting. I've anchored from $30 in December 2024, down to $11 in April-June 2025. The 236 retracement at 15 is our immediate support if the 100 EMA fails. The 382 level at $18 is first resistance. Extension targets: 0618 at $23, 1618 at $43, and 2618 at $63. Those become relevant if we break the descending line and reclaim bullish structure. Volume profile shows point of control at $14.40. That's where the most trading volume has occurred historically. It acts like a magnet. If 236 fib support breaks, 14 is where I would expect price to seek equilibrium before finding support. The Heikin-Ashi RSI is showing oversold readings, not extreme panic, but 9 consecutive red candles is unusual. Extended selling without relief bounces often precedes either capitulation wicks or trend reversals. Here's my positioning. Load zone is $14 to $19. I'm not trying to catch the exact bottom. I'm building position across the support zone. Stop loss is a weekly close below the channel around $12. That invalidates the multi-year structure. If we break down, I exit short-term positions and wait for $10 reaccumulation if the full channel fails. Profit targets scale: 20% at $23, 30% at $30, and 50% at $45. Achievable through June 2026 if institutional adoption continues. Long-term, $63 is realistic by late 2026 or early 2027 if the RWA thesis plays out. These are not hopium targets. They're based on Fibonacci extensions from a defined structure with a clear invalidation level. The setup comes down to one question. Is the market right to ignore institutional adoption, or is this a 6-month lag before price catches up? Best case, we bounce here, break that descending trend line above $20, and start the move toward $23 by November. The RWA narrative accelerates as more banks announce infrastructure deployments, and Chainlink's fee revenue becomes undeniable. Worst case, macro deteriorates, the channel breaks, and we flush to 14 or lower toward $10. At that point, I reassess whether the adoption thesis is real or just marketing. Timeline matters. These targets assume June 2026 horizon, not a swing trade. If you're trading shorter time frames, that descending trend line is your first test. For position building, the channel gives clean risk definition. What invalidates this? Weekly close below the channel. If a major institution exits their Chainlink integration, that shifts the narrative. If RWA growth stalls below 40 billion through Q1 2026, the timeline extends or the thesis breaks. Chainlink's infrastructure deals suggest the market is underpricing what's ahead. 2 trillion in partnerships with price at multi-year support. Either the market is wrong or we are. If this breakdown helped you see the setup clearer, hit the like button. Helps others find data-driven analysis instead of noise. I track these levels and other projects daily in my free Telegram group. Link is in the pinned comment. I've covered similar institutional adoption plays recently. Those breakdowns are on screen if you want the same framework applied elsewhere. Manage your risk, never financial advice, and I'll see you in the next one.